This is Business Weekend with Ross Greenwood.
Hi and welcome to Business Weekend. I'm Ross Greenwood. It is great to have your company today. Coming up on the program, it's been a big week on the markets. In economic news, there's also been takeovers, it's energy stories and politics. We'll wrap it all up for you when we speak very shortly with Funds Management Hall of Famer Catherine Allfrey from Wavestone Capital. Also on the program, the subject of energy, the timing of the agreed $18 billion takeover for Origin could not have been more delicious, just ahead of a decision about whether gas giants should be forced to put more of their product into the Australian system.
To date, that voluntary code has been about making supply available. It hasn't been about making supply available at an artificially low price.
And there's also a big debate about superannuation coming. How much should a person be allowed to have in their tax-free or tax-reduced fund? There's also a new but well-known player entering the superannuation game, offering to cut fees to the bone.
We're here for the long term and we think we can have a real impact in this market.
So all of that and plenty more coming up on Business Weekend. But first, let's go straight to the biggest business story of the week, the hacking of Australia's largest private health insurance fund, Medibank Private, and the way the company has dealt with this growing scandal. The question every Medibank Private customer should now be asking themselves as more highly private information about medical treatment is dropped online is whether the company should have simply shut up and paid the ransom.
I cannot articulate the disgust I have for the scumbags who are at the heart of this criminal act.
Because what's clear to me in speaking with many people on this subject this week is that hundreds of other companies have done exactly that.
The cybercriminal was demanding $15 million from Medibank after stealing the data of nearly 10 million customers. Medibank replied, "After considering all options, we have made a decision that we cannot pay your demand. It is also Australian government policy that ransoms should not be paid. We understand the impact this may have."
For it needs to be remembered, first and foremost, it is not illegal for a company to pay a ransom in Australia. In the case of the Optus hack, for example, almost as soon as the first data was dropped online, the hacker took it all down and apologised to the company. That raised questions as to whether Optus or its parent Singtel simply paid the ransom. Optus has put out a statement saying it did not pay a ransom. Do you believe anybody paid a ransom to that hacker?
I have no knowledge of any such thing.
But whatever did happen with Optus, Medibank's situation is much worse. With Optus, the data leak could identify a person, driver's licences, passport numbers, addresses, phone numbers. An individual's identity could perhaps be stolen to access bank or superannuation accounts. With Medibank, the information being leaked is much more personal. Pregnancy terminations, alcohol or drug addiction treatments, HIV patients. The ability for these people's lives or reputations to be harmed is immense. The hacker has used a Russian dark website, but seems to have exceptional knowledge about Australia and about Medibank.
We believe those responsible for the breach are in Russia. Our intelligence points to a group of loosely affiliated cyber criminals who are likely responsible for past significant breaches in countries across the world. These cyber criminals are operating like a business with affiliates and associates who are supporting the business.
And from the documents released this week, it's also clear that Medibank negotiated with the hacker, maybe in a quest to find out more information, maybe to verify that the hacker had the detailed information they claimed to have. But that negotiation, according to the documents, went on for around 3 weeks. The price demanded was $10 million. It works out to be around $1 per customer record. Just did a quick calculation on my own personal circumstances, being a Medibank private customer. So you've deferred premium increases of 3.1% out until January next year, 3 months. So I've worked out that it's worth $62 a year to me. I'm a pretty significant customer of yours. Does that mean that my data is worth $62 to Medibank Private?
That's absolutely not the case, Ross. Look, This is a malicious attack that's deliberate and has been designed to cause maximum harm and uncertainty, particularly to vulnerable people.
But Medibank's board and management decided against paying the ransom, despite the enormous harm done to the community and to the company's reputation. On Monday, Chief Executive David Koskar said, "We believe there is only a limited chance paying a ransom would ensure the return of our customers' data and prevent it from being published." He went on, "In fact, paying could have the opposite effect and encourage the criminal to directly extort our customers, and there's a strong chance that paying puts more people in harm's way by making Australia a bigger target." Yet oddly, that is not how a hacker's business model works. Many other companies have paid ransoms. Subsequently, their data never appeared online. The hackers, you see, make money by the payment of these ransoms. If the hackers release data after a ransom has been paid, it would not give confidence to the next company to pay up. Medibank took advice from the Australian Federal Police as it decided not to pay the ransom.
To the criminals, you know, we know who you are. And moreover, the AFP has some significant runs on the scoreboard when it comes to bringing overseas offenders back to Australia to face the justice system.
But deep inside Medibank's own governance documents, clues emerge as to what was happening inside the company. Its own appraisal of its board skills puts strategy and governance as very strong. But, on its own admission, the board's collective strength in IT was seen to be its weakest attribute. Less than strong, it says. As part of that statement, the company also says it has zero tolerance for bribery and corruption. It also has a policy that requires directors, employees and contractors not offer, pay or accept inducements, bribes, kickbacks, secret commissions or improper payments, or engage in corrupt business practices. But it does make you stop and wonder, though, whether that honourable objective contradicts another Medibank key governance principle, and that says ensuring the health and well-being of our customers, people and the community.
Now, that information that Medibank keeps is richer, and arguably it's too rich. It's difficult to be so dogmatic about it to just say they shouldn't keep that data, but they should be doing things like tokenising the data. They should be encrypting it so that when it falls into wrong hands, as it inevitably will, that the data is useless to criminal elements. So tokenisation and encryption, these are things that the banks are pretty good at, and we need to see that technology much more widespread in the digital economy.
The markets late this week reacted to what can best be described as euphoria after the US inflation showed signs of trending down. The era of super high interest rate rises might be coming to an end, but others warn about a false dawn and that economic tough times still lie ahead. So let's bring in here Catherine Allfrey, Portfolio Manager and Co-founder of Wavestone Capital. Catherine, always good to get your insight on this program. And this is the problem right now. Do you jump in because it's all over, that really all this effort to try and quell inflation, it's all worked, perfect landing, or is it that you've got to hold back because there just might be something else coming?
I think there's a pretty big change. I mean, when US inflation peaks, you look in history, since 1950, every time it's peaked, the S&P on average has gone up 13% after that time. So if we use history as a guide, you would say, at least put some money to work.
Yes, put some money to work. And is there opportunities there to put that money to work? I mean, you try to look for stocks that have dropped 20, 30% more even in this downturn, yet going to have sustainable earnings. Correct. Are those types of, sort of, if you like, options out there for people to find?
Oh, absolutely. And there's also a real pivot in the market. So, people have been invested in energy stocks, they've been invested in defensive companies, consumer staples, think supermarkets. And so now people are going for the bombed out sectors, the technology shares that, we've seen 50, 60% drops. And that's why the NASDAQ was up so strongly last night. Because they're the high growth companies where you have to look out in the duration. And so therefore inflation and 10-year bond yields are so important for those high growth stocks. And so last night we saw a massive rally as well in the 10-year. And so when you value those companies on the discount rate that you use for that cash flow on a long-term basis, it's come in. So therefore up those stocks go. And so, yes, you've got to find those companies that have been sold off, but also still, like you say, have a good growth trajectory. So in the tech space, we like stocks like car sales or PEXA, where the trajectory over the long term is good quality tech stocks.
Yeah. Okay, so then there's another aspect of this though, and that is whether the story's actually over, whether the dragon of inflation has been slayed, or indeed whether it's just been slowed down a little bit. Because it still seems to me that interest rates are going to continue to rise. Central banks don't want to take any sort of certainty that maybe inflation could come back again. So they're going to try and kill it dead.
Oh, absolutely. So you would still expect the Fed to increase, but they've been running at 75 basis points each month. One would expect that they're going to slow going forward. So yes, we'll still get rate rises over the next 6 months from the Fed and also from the RBA. But hopefully what they're trying to get to is, rather than recession, which is what the market was so focused on, especially in the US, to more of a slowdown, in the economic slowdown, and hopefully, back to that Goldilocks economy where it's not too hot and not too.
So this is the perfect soft landing. Yes. And the question is, that's really hard for central banks to massage the soft landing. They're either got it wrong, in which case inflation stays for longer and they've got to keep the interest rate rises going, or indeed they just go too far and drop it into recession. And not every economy and not every central bank is going to get it right or wrong. Some will get it right, some will get it wrong. That's one of the problems for a market investor, because it could be that there's further shocks, downward shocks into the future.
Yeah, but the stock market always looks 6 to 12 months out, right? We know the earnings warning is coming, and that actually there's quite a few downgrades to come, but the market will start looking through that because it's been priced for that, right? Those stocks have already been hit.
So take me to the very big moves in markets when it reacts. On Friday, we saw it here in Australia reacting to what had taken place on Wall Street on Thursday night. But the thing is also that this is not just driven by the value story. It's actually driven by the way the market works. Short sellers having to cover, have to buy back in. Index funds have to buy in to follow it back up. So there's the weight of money that actually makes these rises or falls much more exaggerated.
Oh, absolutely. I mean, on Thursday night in the US, we saw the biggest move for what they call the short seller basket, right? Since March 2020. It was up 11%, that basket. So that's the sort of volatile moves. Just if you take us back to the COVID sell-off, that's what it was like on Thursday night.
So, okay, so then it comes back to the fundamentals of companies right now. Because even though there might be some companies reporting downgrades, we've seen them even in the past week, the truth is also that a whole bunch of companies have sailed through pretty much unscathed. I'm thinking of a lot of the retailers right now.
Correct.
Record retail sales in Australia for the past 9 months, which is not showing any lack of demand in the economy that the Reserve Bank is trying to quell right now.
Yeah, but the mortgage rates come with a lag in terms of the increase. And so I think for retailers, they'll feel it in that second quarter of next year, from that June quarter. And so therefore you will get pretty moribund retail sales as those mortgage rates bite, but also energy prices are going up 50%. So that's also going to impact retail sales.
And that's going to go to, manufacturers. That's going to go to brickmakers like Brickworks, for example. It's going to go to a range of companies that have got to feel the higher input costs and potentially even higher labour costs as they go forward.
Yes, absolutely. That's exactly what's going to happen in 23. But hopefully it's not a recession, it's a slowdown.
Okay, so then you get to the final part about this, is when you sit there and try and analyse the stocks that you want to buy or those that you want to discard, you're looking at balance sheets. You've got to look forward as to the types of stocks, the characteristics that they have. You mentioned about looking for cash flow in the tech sector. You mentioned a couple there. What else is it you're looking for?
We always have the same process, right? We look for quality companies at reasonable prices, right? We don't want to pay too much for growth. But so we'll continue to look at those balance sheets, make sure that there's a good solid balance sheet, but also that the company has a good trajectory over 5 years. And we always value the company over 5 years when we buy, and we look for those mispriced opportunities on a longer term view.
And that is exactly what investors should be doing who are watching this right now.
Hopefully.
Follow the Catherine Allfrey way. I'm going to tell you, from Wavestone Capital, always good to chat to you, Catherine. Many thanks for your time today.
Thank you, Ross.
This week, the energy world was rocked by an audacious $18 billion takeover bid for Origin Energy, one of Australia's 3 big energy producers and retailers. It came from Brookfield, which previously had bid for AGL, and also the gas giant EIS. But the timing of the bid comes as the government considers pulling a so-called gas trigger to force energy companies, including Origin, to divert more gas into the local market. Joining me now, Saul Kavanagh, energy analyst with Credit Suisse. Saul, good to have you on the program. The timing of this is the thing that really sort of intrigues me. Why would you make an $18 billion bid for a company like Origin when you don't quite know what the government is going to do, forcing you to put more gas at cheaper prices into the local market?
Well, indeed, and we're seeing unprecedented calls for intervention into the gas market as we speak. We're expecting an ACCC report imminently with recommendations how the government can intervene to bring down prices, including the potential for a price cap. And we could actually see when you have M&A deals like this one being proposed, the government could actually use some of the leverage it has to enable approvals for such deals to actually try and extract even more concessions from gas players.
Now that's interesting. I've not thought about this. So in other words, it could say, sure, you can make this takeover, but you also have got to give us the concessions that there will be sufficient gas and you won't divert that uncontracted gas into the international markets.
And it's a matter of time until we start seeing some lobbying and moves, I think, from the government in that direction. Because if you look at the interventions the government's actually proposing, they're all actually very challenging to implement. When you actually get to specific mechanisms, they're going to be subject to legal challenge, WTO challenge, bilateral investment treaty challenge and constitutional challenges.
Because let's be honest, when those Gladstone LNG plants were set up, the three of them on Curtis Island, that was tens and tens of billions of dollars that came from overseas to ensure gas supplies to Korea, to Japan, to other countries overseas. They're not going to take kindly to the fact of saying, well, actually, here we are, Australia, we're now short of gas, we need some of that back into our own local system. That horse sort of bolted when Australia took the tens of billions of dollars off them to develop Curtis Island.
And some of the international players there have already got legal advice, have already behind the scenes threatened the legal avenues to challenge they can have. And that's why if you have an M&A type deal going on, this could provide a different avenue for the government to go down where it's not going to face the same legal challenges as it will with direct intervention via regulatory mechanisms, for example, via the Code of Conduct, which is being proposed at the moment.
All right, because at the moment it's a voluntary code, right? So there's contracted gas, which the government understands has to go overseas. It's the uncontracted gas element. Now, that's a so-called gentleman's agreement, a voluntary code. But the reality is, if you can get more gas, more money sending that gas overseas, you're going to do that as a business. You're not going to leave it in the domestic market if you get a lesser price.
Well, let's be honest, this voluntary so-called code is being done under threat, right? So it's not all that voluntary. And the reason industry has been willing to support it is they realise there's a social licence issue here, but also because to date, that voluntary code has been about making supply available. It hasn't been about making supply available at an artificially low price. But that's now where the government's going. The architecture's been put in place over the last 5 years. Like we saw the kind of the slippery slope towards price controls. That slippery slope, we're well down the slide now.
Yeah.
And the government's just looking at how to effectively do this. And I think what we're going to see when this ACCC report comes out and an actual firm recommendation on policies put on the table, only then will the battle on East Coast gas really heat up, because that's when industry is going to start its lobbying effort, its legal efforts, and that's when the real fight's going to be on.
OK, but then there's another thing, because industry says we think if you mandate that gas to be kept in the local market at around $10, $11 per petajoule is what they're talking about. And they say, well, that's twice the price that it has been in the past. The reality is, though, that's still relatively expensive gas coming into the system if you want to generate electricity, for example, and using gas as transitory fuels to get us to renewables.
Look, there's a lot of problems here. So the whole world has changed for energy in the last 9 months. And the truth is that was changing even before the Russian invasion of Ukraine, which then exacerbated and threw kind of diesel on the fire, or gas on the fire would be perhaps more apt. Now, what we're seeing at the moment on this is a lot of calls to go back to single-digit gas prices.
Yes.
Right? The problem with trying to implement this is just in the very near-term reality is if we were, for example, to see $10 gas, you're going to see huge spikes in gas demands. You're actually going to see turning down coal-fired power generation, spikes in gas demand. What's that going to do? That's going to see big spikes in demand in the power sector, take it away from the industrial sector. We'll see acute shortages for manufacturing and industry and all the jobs associated with that. So you've already started to see, for example, Dan Walton, the head of the Australian Workers Union, calling for regulation of coal prices, because what they're realising, if you want to regulate the gas price, you also have to regulate the coal price. If you want to regulate the coal price, you're going to have to regulate the downstream of both gas and coal, and then power markets. And so with this slippery slope idea is, we're now well on it, where the government's going to have to become increasingly interventionist, not just on one part of the value chain, but the whole energy value chain, and it's not equipped to do so.
And what it doesn't do is address the real issue that would fix the gas markets in Australia, and that is put pressure on the state governments to produce more gas of their own. That's what's been missing. That was what was always assumed when the Gladstone gas plants were created in the first place, is you could have all that gas go overseas, because here in Australia there was plenty of other gas that was under our feet. But that gas was never exploited.
Obviously, more supply is the most elegant and only structurally sustainable solution here. You've got to remember, when all the interventions started back in 2015, the ADGSM mechanism was put in place, all the interventions were meant to be temporary until we saw supply-side fixes. You know, what you're talking about, getting the states to develop more gas. But as happens, those temporary regulatory interventions are now becoming permanent, are becoming tougher, and there's no actual progress on the structural change to bring on more gas supply. And the inequity of this is apparent. If you're a Queenslander right now, you've essentially got the federal government calling on Queenslanders to get less prices for their gas, less taxes for Queenslanders, to send that gas to the southern states, so like Victoria, where they refuse to develop their own resources. Now, that's going to go down like a lead balloon for the folks in Queensland. And, you know, there's a lot of talk about export restrictions, but perhaps Queensland would like to see export restrictions to the southern states rather than to their export markets.
I'll tell you, Saul Kavanagh from Credit Suisse, great to get your insight. We'll do it again very shortly, because this subject is probably the burning issue, as you say, right now in Australian industry, but also in those Australian energy markets. Many thanks for your time.
Thank you.
Well, coming up after the break, how much is too much to have in a superannuation fund? Plus, a new player takes on the industry super funds with cheaper fees. Thanks for being with us here on Business Weekend. This week, the government opened up a community debate about the tax benefits of superannuation. It noted there are 32 funds with more than $100 million in them. The biggest has $401 million, all enjoying lower taxes than if that money was outside of super. Well, this week I spoke with the Financial Services Minister, Stephen Jones.
Now, somebody with 100 or, as you say, $400 million in their superannuation account, nobody can seriously be arguing that that's for retirement purposes. Good on them. They've found a way to minimise their tax, but it's actually, you know, it's distorting the system.
Well, to respond to this debate, I also spoke with the opposition spokesman and Shadow Assistant Treasurer, Stuart Robert.
It's the ultimate definition of politics of envy. Unfortunately, Labor went to the election saying no changes to superannuation. The Treasurer said the super wars are done, but here we find, mere months later, the Assistant Treasurer looking at every opportunity to whack anyone that's done well, anyone that's got ahead, indeed anyone with aspiration. I've got an idea, Ross. How about the Labor government keep their promises? How about we start there?
All right, keeping promises is one thing, but taking the mickey out of a system that is actually set up in some ways to make certain people can look after themselves in retirement, not transfer wealth to another generation. There is an argument here that somebody with $400 million in super paying little or no tax, that is beyond the pale of what the system was created for.
Well, let me just correct a few things. First of all, to get $400 million into super, and there's one person. Just one, so you don't make laws for one person out of a country of 25 million. But let's deal with this one person with $400 million. With concessional contributions at 25,000 or thereabouts, that money would have gone in as non-concessional, so would have been taxed ostensibly at their marginal rate or lower. There's a transfer balance cap at 1.7 million, so anything above that in retirement stays in accumulation and is taxed. And of course, with the Div 293 set at $250,000, they're paying 30 cents on any income above that. So they're being taxed in three spaces there. So not quite genuine, Ross. Can I push back gently in terms of people taking the mickey?
OK, but is it time that we have a conversation about how much super is enough? Even in government, your side of politics did limit the amount of money that people could put into superannuation. So you clearly, on your side of politics, have had a conversation about this.
We did, Ross. We put a transfer balance cap in, which previously there wasn't there. We moved the Div 293 down from 300 and above down to 250, and of course capped the level of contribution. So we did absolutely that to ensure there was an appropriate ceiling. Now, I think a conversation is always warranted on any subject, and we should have an open conversation. But before you make substantive changes to people's retirements that has a lifetime impact, that should be taken to an election.
OK, because the other point here is that maybe many of those caps are not high enough. And yes, maybe $400 million is way too much to have in a superannuation fund. But the fact is, even $1.7 million as a maximum you can have in a pension and retirement, which is therefore income tax free, the reality is that $1 million in a 4% account is only going to give you the equivalent as a couple of what the age pension is paying right now.
No, I agree. So perhaps the transfer balance cap is too low. Perhaps the concessional and non-concessional rates are too low. Perhaps we need to have higher catch-up rates, especially for women who find themselves in childbearing age and then come back into a workforce. They're all appropriate comments to make. I think the Grattan Institute believes there should be no transfer balance cap. So there is a wide view of opinion. Let's ventilate it. Let's have that conversation, but on the grounds that when we arrive at whatever solution should be, that the Australian people will have an opportunity to make a judgment on this at an election. Labor can't come in and say there should be no changes and then a few months later pull all these ideas out. It doesn't work that way.
OK, I do get that, but then there's a second argument here, and that is given that stage 3 tax cuts may very well become an election issue next time around, whether they exist as they currently are or whether they change. And this whole issue about changes to superannuation taxes, it's got to go to an election, I agree with you, but you can't have one conversation about, the welfare system without having a conversation about the tax situation we've got in Australia, because ultimately taxpayers are the ones who pay the concessions to those who are in retirement.
Yeah, no, I agree with that. And that was the whole point of the retirement income review, was to look at the entire retirement system. And the retirement system, as you know, includes the Australians' biggest asset, called their primary house, their second biggest asset being superannuation, their taxation through their working life, how the welfare system interacts with it, how industrial relations connects with them, the opportunities and the incentives and the disincentives to save. All of this is part of the retirement system. And there is an argument for have a conversation about it all. And we should do that. That's what politics should do. But any substantive changes must go to an election.
OK, but then one thing that Australia is noted for is many consider around the world that this is one of the finest retirement incomes policies that any country has got. It's not only compulsory for people to save for themselves, but they have ownership of those assets. And ultimately, there are concessions there. Why would we tweak with it at all? That's one other question.
At some point, we've got to settle the super wars. And this is why I took heart from the Treasurer a few months ago when he said it was settled. And then, of course, they start flying kites everywhere. When you're planning for retirement, you need long-term settings so you can make long-term decisions, especially in a country where we've got the third highest taxation regime when it comes to personal exertion. So you work and then you pay PAYG. So because of that, because we are taxed so heavily in the PAYG space, there's got to be a long-term view. And this has to settle down and to say these are the rules, this is what it looks like. But having industry super coming out, belting up the self-managed super fund industry, that's not what this is all about. We've got to settle it down, agree on the rules and don't touch them. And that was the point of the transfer balance cap, and what the Coalition did a few years ago was just to settle that equity argument.
OK, before I let you go, can I get you to put your hat on? You were the previous Employment and Workplace Relations Minister in the government. Right now you've got industrial relations laws that this week have gone through the House of Representatives. Do you imagine that the government is going to be able to get these through the Senate in the sort of shape in which they're hoping to achieve, at least anyway?
Well, the nation can only hope and pray that they don't. Again, they didn't take this to the election. No one heard about pattern bargaining. All we did in the 70s, Ross, you and I can remember back then, which caused mayhem and chaos across our working areas. It wasn't raised. Now they've dressed it up, given it a brand new name in terms of multi-employer bargaining. It's the same thing. It's about taking 1,000 businesses that all have the same sort of name or provide the same service and putting the same union-imposed costs upon them, regardless of whether or not they can sustain it. Government needs to get out of the lives of Australians. The government's saying this is about better pay and better conditions, where we're seeing the wages price index move. We're seeing, in terms of national accounts, the average earnings, which is a better understanding of where wages are. Unemployment at 3.5%. I mean, extraordinarily low. This is the policy looking for a problem. And I can only hope and pray the Senate says too fast, too much. It's a retrograde step, and we don't need it.
Shadow Assistant Treasurer Stuart Robert, always great to chat to you, and many thanks for your time on the program today.
Great to talk. Thanks, Ross.
Well, as that superannuation debate rages, another fight is just beginning. The attraction for industry superannuation funds over banks and insurance companies has always been about fees. By being large and not-for-profit, the industry funds could usually offer cheaper fees and therefore better returns. But a new player, Vanguard, one of the biggest investment managers in the world, could change all that. Vanguard is no stranger to Australia or to self-managed superannuation investors. But for the first time, it will offer My Super products to retail superannuation customers. Vanguard's Australian Managing Director, Daniel Shremsky, joins me now. Daniel, many thanks for your time. The question most people will ask is, why did it take Vanguard so long to get to this space?
Oh, look, thank you for your time, Ross. I'm excited to launch Vanguard Super today. Look, I think it's a massive responsibility we take on to manage Australians' retirement, and we've obviously gone through a process to get to this point, and we're here for the long term, Ross. It's not about 6 months here or 6 months there. We're here for the long term, and we think we can have a real impact in this market. And day one today, we couldn't be more excited. It's a special day for Vanguard.
Okay, so this is all about index funds and therefore your ability to offer cheap products. The attraction of index funds has always been that if there's a shock in the market, that the index will always adjust to that, and probably some fund managers will not adjust as quickly. That's the key to what you're attracting new customers into this product with, isn't it?
Absolutely. Our My Super product is going to be a life cycle product, which essentially will adjust risk based on your age. So as you get older, the investment will become more defensive. And as you're younger, it will be more growth focused. So therefore, as you do have market events that take place, it won't impact your retirement savings as you get closer to retirement. So we think it's a really innovative life cycle product that we're bringing to market. And again, our experience in the US through managing similar types of product has given us a lot of expertise in this space, and we think it's going to deliver fantastic returns for Australian investors over the long term.
I mentioned in the introduction that one of the advantages that industry superannuation funds have is their scale and the fact that they are not-for-profit. By that scale, they can also start to offer lower fees than typical retail funds from banks and insurance companies were able to offer. But in your case, by chasing indices, that this is a way, another way, a different way in which you can offer those cheaper fees that ultimately do benefit the customers.
Absolutely. Look, our fees, we are, this is day one, as I said, Ross, and we are amongst the most competitive in the market on day one. And again, more savings in Australians' pockets for their retirement is a critical part of superannuation. Again, what Vanguard has done across any market that it's entered, that as it has developed scale, as it has grown, it has given more benefit back to the investor, and that's what we commit to do. Again, we think our offer today is low across the board, but it's certainly also lowest in some particular segments in the My Super space. So, look, more to come. This is our day one offer, and we've got a history. Over the last 10 years in Australia, we've had more than 40 price reductions across our investments. So we've got a track record, and certainly we think we've developed credibility in that space.
Okay, for people who've never heard of Vanguard, of course, John Bogle set it up all those years ago, almost 50 years ago. Tell me just how much in total assets that Vanguard has globally right now.
Yeah, we have 10 trillion assets globally right now, and obviously huge scale. And again, a really exciting part of launching Vanguard Super in Australia. We're able to take advantage of that scale, but it's even more than just the scale, Ross. It's also the expertise. We have local expertise, but we have global infrastructure. And again, we've learned so much over the last 45 years in investing globally, and bringing that into the super market is we think a real differentiator and a big advantage to us. But $10 trillion is a lot of money, and locally in Australia we have $100 billion. So we also have scale locally, and again, I think that puts us in a position of strength.
Okay, but then there's one other aspect of this. Even though super is now for choice, of course, many industry super funds have been aligned with employers, and so that's made it easier for them to accumulate funds. How will you be able to accumulate funds in that way? Or is it simply by word of mouth and simply advertising that you can actually get the message out?
Yeah, I think it starts with our offer, Ross. And again, the expertise, the fees. We've developed a strong brand with financial advisors. Financial advisors have been a core part of our business for a couple of decades now. So we have a good brand there. We absolutely have to expand that brand into the retail space. But look, we have 20,000 expressions of interest, people that have jumped on our website over the last 12 months and expressed interest. Certainly, we think that's they're prospects that we'll obviously work with in the short term. We also have over 90,000 personal investor clients who have invested through Vanguard outside of their superannuation. And then, as I said, again, we have a loyal group of advisors who think similarly to us. We think that's an exciting avenue of opportunity for us, where we can give them, the advisors, access to Vanguard Super with no platform fee. And again, that should appeal to some of their end clients. But absolutely, the corporate space is another area that in time we will look into, and we will work with organisations that we think can benefit from Vanguard Super. So we think we have multiple entry points into the Australian market, and over time we're going to leverage those. But again, this is our starting point. The offer will evolve. We will listen to our members, and as we do so, we will continue to refine the offer and hit some of those opportunities in the market where we think we can succeed, and ultimately our members can succeed.
Daniel Shrimsky, Managing Director of Vanguard here in Australia, many thanks for your time.
Thank you for your time, Ross. Appreciate it.
Coming up after the break, we take the pulse of the economy as we speak with the Chief Executive of Westpac, Peter King, plus also the Editor-in-Chief at Vogue Australia, Edwina McCann. Thanks for being with us here on Business Weekend. This week, Westpac revealed that its profit for the last financial year fell 1% to $5.28 billion. It was a tale of two halves, though. The second half markedly better because of improved margins as interest rates have risen. Westpac's dividend 6% higher, and you can see here $1.25 per share for the full year. In a changing economy, I spoke with Westpac Chief Executive Peter King earlier this week.
I'd describe it as a slowdown, actually. If we look at GDP growth, we're expecting that to slow down. We're thinking about lending demand for the banks being a little bit slow down. But when I think about the bank, we've built our capital levels, we've got good liquidity buffers, and then we've provided. So the bank's in really good shape going into a slowdown. So I actually feel like the bank's well positioned to help customers, because the reason we built liquidity buffers and capital buffers in particular was we can provide customers with time to work through some of the challenges that the current environment is throwing up. And I would say to any customers or anyone listening to the show, if they do need help, it's best that they call us early, because there's more options for us to help.
Is there an issue here that APRA, the banking regulator, basically stress tested mortgages, or asked you to stress test mortgages at a point which the Reserve Bank is now very close to? So in other words, future interest rate rises go beyond that stress test. Is that where the hurt might occur?
Yeah, you're right. When when we lend, we assess people on a higher interest rate than what they're actually paying at the time. So there is a buffer. It was 3% for the last 12 months is that buffer. And what we know is that obviously the cost of living's going up, so energy, food, the cost of debt's going up, and it's hard for us to really understand individuals' increases in salary. So that's the bit what we're looking for. What we're seeing right now is actually less people in trouble. So 30-day delinquencies is what we watch. They've come down again in September, and they're back at the levels that we saw pre-COVID, in fact.
Isn't that odd to you? Because that almost goes alongside retail sales being at record levels for the past 9 months. You've got no stress, you've got no delinquencies there. In fact, they're coming down. People are managing somehow. Higher prices, higher interest rates. That's not what the Reserve Bank sort of expected to happen.
Well, there's a bit of a lag. So firstly, yes, on average, customers look like they're in a decent shape going into the tougher times. So that's a positive. But as I said before, if you don't feel that way, you should call us early. But there's a lag between the RBA rate moving and then the monthly repayments on mortgages changing. So we're yet to change probably the last 4 interest rate rises in monthly repayments for mortgages. And so they're still coming, and there's a big lag effect between the impact on the cash flow of the customer and the change in interest rates. Not everyone will see their monthly repayment change because as interest rates fell, they kept their monthly repayments higher than what they needed to, which meant they were paying off their mortgage quicker.
So then there are those on fixed rate mortgages, and at one stage you got up to around 40% of people taking out new mortgages, taking out 2 to 3 year fixed rate mortgages. They've got to come off. They're the people who potentially really do feel the jolt of higher interest rates.
Yeah, we'll step up. I think a lot of people were very smart because they reduced their cost of borrowing by taking advantage of the low interest rates. But again, when we assess a fixed rate mortgage, we assume they will roll onto a higher variable rate. So we did factor that into the assessments. But like all the times, things change, and we've just got to be cautious, encourage customers to talk to us if they don't feel they're well prepared for these increases.
When I talk to bankers generally, they say there's 2 areas where they see real concern. One is commercial property. The cities largely have been hollowed out by COVID, and people have not necessarily come back to the cities in the way in which they did, all businesses. And the second one is cafes and restaurants and takeaways. Yet, oddly enough, the sales there have been very strong in recent times. Is that similar with Westpac?
Well, I think discretionary, on the latter point, as you spend more of your wages on mortgages or rent or on food and energy, then what gives is discretionary spend. Buying a discretionary good or consuming a service that's more discretionary. So I think it's fair to watch out. I wouldn't just say it's cafes and restaurants because it's not a one side. It's going to be uneven as we go through this. But yes, we've got to watch those sectors. And then property, to me, in mortgages, people normally get into trouble when they lose their job. They get sick or they get divorced, unfortunately. They're the sort of the 3 big drivers of mortgage stress. And so we'll see probably unemployment going up. That'll be one of the outtakes of higher interest rates. As the economy slows a bit, we will see unemployment going up. 4.5% is our expectation. That's around the average of sort of historical average, but still higher than we've got today.
Which works out to be about 150,000 jobs lost in the Australian economy if the unemployment rate goes to 4.5%. As you say, that's a longer term average, but it's still people who have to manage and cope, and therefore banks have to cope.
And that's the point where we started today about we built our liquidity, we built our capital, so we've got time to work with people through the next period.
Peter King, good to talk to you today.
Thanks, Ross.
Now, while bankers might be cautious about the road ahead, shoppers seem to be taking price rises in their stride. 9 consecutive months of record retail sales. So they're bringing the nation's cities back to life. A great example is a revival of Vogue's American Express Fashion Night Out, which brought together industry and consumers after a long hiatus during COVID. One of the best people to gauge the shopper's mood, consumer behaviour and the fashion that comes from it is Vogue Australia's Editor-in-Chief, Edwina McCann.
We've seen booming luxury sales, booming luxury results. At our recent shopping event, we saw basket sizes of $240 average. I mean, that's up almost $50 from 2021 when we had an online event. So, and that's when everybody was locked up and had all this extra money to spend. So we're not seeing any sign of it quietening off at the moment.
And it was always thought that maybe our cities were basically going to die post-COVID, but it seems now our cities have got new life, and it's the shoppers who are bringing that life to them.
Very much so. I mean, we've seen the cruise ships return to Sydney Harbour and, thousands of shoppers, potential shoppers, walk off those ships, walk into the restaurants, buy the designer goods along George Street now or Elizabeth. So, yeah, again, it's just, I feel like our cities have really come to life, and perhaps we're appreciating them a lot more than we used to. And so we're really thinking about all the other things we can do in the cities. I mean, if you look at something like Westfield and the CBDs, and certainly Chadstone down in Melbourne, they are again booming.
So this is curious because there's got to be a day of reckoning. We know eventually interest rates are rising to quell the consumer's demand. But what you and I are talking about here is that somehow people are absorbing these price hikes. They're getting on. The question is also, what are they buying?
Well, that's the thing, right? At the very top end, I mean, there are wait lists for Hermes bags. These are $20,000, $30,000 plus bags. And quite often, you're a chosen customer who's a customer of ready-to-wear before you can even go on a waiting list for those bags. We're seeing, Range Rovers, huge wait lists for new Range Rovers. So the top end, they're buying the very best of the best. We're seeing, multi-million dollar pieces of fine jewellery sold in this market to the domestic consumer. And then I think if you look at the sort of the more middle, there's almost a new normal in terms of an Australian consumer's tolerance for price hikes. They are paying more for goods that are sustainable or sustainably made. They're willing to pay more for quality fabrications. And I never really thought I would see that day, I have to say, quite cynically. So, and still, I mean, a good offer. I think Australians are still really interested in value. Certainly at American Express Fashions Night Out, we saw that offers really did drive that consumption. So I think people are still smart in the way they're shopping, but they want to shop, I think. It's a little bit like travelling, right? We were all desperate to get on those planes, and it really didn't matter that the price were hiked by 30%. I mean, it drove us all mad, but guess what? We still got on those planes in droves, and we're certainly seeing the same thing with this appetite for retail and celebration. I think the racing season really drove a lot of people into stores. They may not have been going out to the track, but they were absolutely fine to go out and have that Melbourne Cup lunch.
Okay, so I want to take you back to the luxury sector, because the luxury sector was built here in our major capital cities off the back of, in particular, Chinese tourists who are consuming large amounts of those luxury goods. But of course, they're gone. They're not here. And so the question was, who was going to replace it? Or would we find that these lovely strips of retail in our cities would just evaporate? It hasn't happened.
I was worried during COVID. I thought, what's going to happen to our business and our marketing budgets now that the expat Chinese, a university student, for example, isn't really there in droves, although apparently they are returning, as are a lot of Southeast Asian students, and they definitely do fuel a bit of the market. Certainly that tourism dollar isn't here. And I think a lot of the regional heads of the luxuries believed that it was all the Chinese consumer that was driving this consumption. And then during COVID, they had to switch to the Australian domestic market, and all those, all our billionaires who were suddenly locked up at home. And I think what's happened is locally they've developed really good concierge services and really good relationships with customers who may have been a customer in the UK or New York, and suddenly they're very well connected and very good at managing their VIPs, and they were reporting back to Australia, well, you've got one of our best customers at home, we need to get them this good, they're kind of asking us for it. So now they've got those connections, and I can see just with all the private events that they're hosting at the moment, they are really looking after them.
Okay, so do you think retailers, and the fashion industry especially, do you think that they've even gotten their cognizance that there is a slowdown coming? That the Reserve Bank is deliberately trying to quell this consumption that you and I are talking about?
Well, this very top-end consumption, you'd think how much of them actually have debt anyway?
Yeah, driven by house prices as well.
Exactly. Is this impacting them at all? I don't know. But certainly I would have thought the middle market who perhaps had, bought up and still bought the designer handbag, even at the prices that you look at with sort of Michael Kors, for example, a New York designer, that's what you would probably call entry point luxury good. But again, sales are really strong, and those brands are doing well. So we're just not seeing a cooling off yet. And I do worry that, we've all drunk the Kool-Aid and we're a bit drunk on success, and suddenly we're going to wake up one day and it might all be over. But then, you talk to businesses like Rolex, for example, the wait lists are huge, so they're committed customers. Quite often people have paid up front and they're waiting for goods. It's more still a supply issue than a demand.
Edwina McCann, it is always lovely to chat, and thank you so much for your time.
Thank you, Ross.
So that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up to date with all the latest business news with our daily program Business Now, 4:30 and 11:30pm Eastern Summer Time. You can also see this program again via our website skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.